So for this class, we're going to assume now that you've crafted the perfect offer. You've nailed your price and you're finally under contract for your dream home. So we're going to start with walking you through the entire process from contract all the way through closing. Let's jump in by starting at our initial inspection. We've already covered the inspection contingency and why it's so important that's part of your contract. So we're going to assume first things first, you're under contract and now it's time to have that inspection. Most people are going to get their referral for a good inspector from their realtor. So if you don't know where to start, again, lean on the professional you've elected to use and ask your realtor for a great recommendation for an inspector. This is one of the more important decisions you make because the inspection, as we discussed earlier, is so critical to understanding what type of investment you're buying and how sound this home is as an investment. So some things that you can do to double and triple check the recommendation, look online, look at their reviews. Make sure you're working with someone that's credible and has a ton of experience. The inspection is going to be 100 pages sometimes. So it's not something that you want to be able to walk through by yourself. You want to have a good professional that's going to walk you through the inspection report and tell you what are the major issues with the home and what are the minor ones that maybe okay overlooking. And then most importantly, let's understand what to look for in an inspection. It's important to understand that on an initial inspection, the laundry list of items that an inspector can flag can be extremely long and daunting. So, again, lean on the professional to walk you through this. What we're going to focus on are the big ticket items that you need to be aware of. Meaning, if the inspector flags one of these items, your red flag needs to go up and you have to be alert and make sure you're making good decisions moving forward. We're going to cover again a couple of the big ticket items. Let's start with foundation issues. If there are structural problems with the home, like a cracked foundation or a damaged load-bearing wall, this could mean that the house is not structurally sound. This could lead to major issues and a major repair to the tune of $20, $30, $40, $50, $100,000 in cost for you as the buyer. Not only that, the foundation is part of the big three for mortgage lenders, meaning if there's an issue with the foundation, a lot of the times it will disqualify the property altogether for financing. So if this comes up on your initial inspection, most of the time what you're going to be recommended to do is get a structural engineer out there to actually certify the foundation and tell you exactly what's going on. This will be an additional cost to you as the buyer to have an engineer come out there and look at the foundation in detail. This could add $500, $1,000, $1,500 of additional costs in an additional inspection. So it's something to be wary of, and it's something to address upfront with your realtor and your inspector if it does come up. Next is the roof. Roof issues, again, part of the big three when it comes to mortgage lending. So it's extremely important that your antenna is up if a roof is listed as a major problem on the inspection report. Roof issues are extremely costly, right? It could cost you $20, $30, $40, $50, $100,000 in additional costs to replace a roof. The lifetime of a roof is typically very long. So this would only happen if the roof is 20, 30 years old, or if something damaged the roof, such as hail or some other type of catastrophic roof weather event like a hurricane. Next up is our HVAC. HVACs are really expensive pieces of equipment. So we want to make sure that they're still within their useful life period and that the HVAC is 5, 10 years old. Once you're 15, 20 years old on an HVAC, chances are it's going to give out soon or it's going to become more and more expensive to fix, to maintain, and to repair. Next is mold and water damage. This could be very serious and it could actually impact your health. So if there is mold, most of the time you're going to be expected to call on another type of professional to analyze the mold and the water damage extensively. If this is part of the inspection report, ask the inspector what they think of this issue and then immediately try to get another professional out there to analyze this and tell you if this could lead to any type of health issues in the future. Next are wiring or electrical issues. This could be expensive to repair depending on how old the home is. If the home is very old, that usually is going to be a high ticket item and it's going to lead to be a very costly item to replace or to repair. Because a lot of the time you have to end up doing the entire wiring on these old homes. So it's something to, again, be aware of and alert of. Next are plumbing issues. Faulty pipes hidden behind walls or under floors. This can be very expensive to fix, especially again in old homes. So something to be careful of, something that we see here in Texas and in Florida and some of the homes in the Northeast, cast iron plumbing. If this comes up, you want to be wary because a lot of the time you have to replace the entire plumbing system in the house these days if something does happen. So just remember, this could be something costly, and then a lot of the times with these types of issues, you'll be expected to call on a different professional to come out there, a plumber, and really tell you what's going on with the plumbing and the internals of the home. Last but not least are signs of termites, wood destroying organisms, pests. This is the last part of the big three for lenders. If this comes up in the inspection report, you're going to be called on to get a termite professional out there, give you a separate report. This is not typically expensive, figure $200 to $500. But if it shows that there are active rodents or termites or any type of wood rotting organisms, you are going to be called on to fix this prior to it qualifying for financing. So this could be a costly repair that you have to make in the middle of the home buying process. This could typically run anywhere from $500 to $1,000, and it usually will take time to address these types of issues. So again, it's something to be aware of. If any of these issues come up, just do the right thing, slow down the process, start to fall back on your contingencies, have the honest conversation with your lender and your realtor, and make sure you have a solid game plan to Very rarely will an inspection report come back and be completely spotless. It's just not the way that real estate typically works. So as a successful home buyer, we want to be prepared for what comes next. Typically, an inspection report with issues is going to lead to a period of renegotiation between buyer and seller. One thing to understand as the buyer, if there are issues with the home and you have to call on other professionals and get estimates, this is going to be your responsibility as the buyer. You will take the brunt of this responsibility and the brunt of this cost. Now, when we renegotiate with the seller during our inspection period or because of an inspection, there are 5 typical outcomes. On both ends of the spectrum, there's termination. The first one is you think that the issues are too extreme, so you don't want to deal with the headache and you want to terminate the contract. That's one end. On the other one is the seller is not willing to negotiate and they don't want to play ball, so you end up terminating the offer. Now, most of the time it doesn't shake out like that. Usually it's going to land somewhere in the middle. So let's start with the different options that kind of fall in between the two extremes. Let's start with the best option. You ask the seller to cover all of the repairs in the form of a price reduction or a seller credit or concession, and the seller says yes. That's the best outcome, right? You still want the home. You understand the issues aren't too extreme, or your lender tells you, hey, we can still finance these issues. So you decide to move forward with the property and the seller makes you whole. The next bet is meet somewhere in the middle, right? So maybe the seller doesn't say, hey, I'm going to cover everything, but you want the home bad enough, and to you, it's worth coming out of pocket a little bit to take care of these repairs. So you meet in the middle. A quick note as we renegotiate with the seller. If the issues found on the inspection report were disclosed to us up front, the chances are that the seller has already backed in the cost of repairs into the agreed upon purchase price. It won't necessarily hurt you to ask and try to renegotiate, but it's important to understand what the seller is likely to come back with. So if it was disclosed up front, chances are high the seller is not going to be willing to renegotiate again. Now, if these issues were not disclosed up front, it's a great time as a buyer to renegotiate like we discussed. As the buyer, why should we hold the bag for issues that were not disclosed up front? Then we have the worst option, which is having the seller complete the repairs on their own dime. That's because the seller is not going to be motivated about the quality of the repairs or doing the repairs right. They're going to be more concerned with just getting them done. So if you end up going down this path, make sure you take the necessary time to vet the third-party contractors that the seller is electing to use. That way, you make sure that you're protecting your investment and that you're happy with the repairs and the end result. So at this point in the process, we're assuming that we've gone through the renegotiation period, we're happy with the results, and we're finally ready to move forward. Up next is the appraisal, which is a very important part of the process and very important piece to obtaining a full loan approval from your lender. Usually, your lender is going to call on a third-party appraiser to go out to the home, inspect the home, and give you the true value of your home. They will take into consideration a couple of things. The most important one is going to be the comparable homes that have sold recently in a close proximity to the home that you're under contract for. Next, what they will consider is your purchase agreement. They do weigh in what you are willing as a buyer to purchase the home for. Appraisers are completely neutral. Realtors, of course, can prepare comps ahead of time at the beginning of the transaction and provide those to the third-party appraiser. However, it is completely illegal for a realtor, lender, buyer, or seller to try to impact the value that the appraiser is going to deem on the home. It has to be like church and state. So most of the time, the lenders and the realtors are going to stay far away from this portion of the process. It's the lender's responsibility to deem whether or not the transaction requires an appraisal. Sometimes, on about 10 or 20% of transactions, the lender will waive the requirement for an appraisal altogether. This happens when Fannie Mae or Freddie Mac, the federal agencies that insure all conventional mortgages in the US, have a recent appraisal on file. Besides that, appraisals are required on almost every type of purchase transaction. The faster you get the appraisal done in the process and the appraiser comes back and tells you the value, the better off you are as the buyer. So let's now jump into what are the potential outcomes of the appraisal. Once your appraisal comes back, there's really only 3 outcomes that can occur. This is what we call the good, the bad, and the ugly. The good is when the appraisal comes in at value, meaning the value was equal to our purchase price. If it comes in above value, that means we have instant equity, which is a great thing. Pat yourself on the back, give your realtor a big high five because you negotiated a great price. Let's move on to the bad. The bad is when the appraisal comes in what we call subject to, meaning subject to additional repairs. This is a great time as a buyer to renegotiate, just like we did in the last section during the inspection period. A lot of the time, you're going to be further along in the transaction. The seller is going to be amiable because they understand you're not just requiring it, the appraiser and the mortgage bank is requiring it. So a lot of the time, the seller will roll over and make these repairs for you. Now, let's go over the ugly. The ugly is unfortunate, and this is when the value comes in below the agreed upon purchase price. This can be very problematic as a buyer because you're left with only a couple options, which are to renegotiate the price with the seller, dispute the appraiser and try to get that appraiser to bring the value up, or terminate the transaction altogether. The last option would be to cover the gap with cash, which us as a lot of buyers don't want to necessarily do, especially after a third-party appraiser told us that the value was not worth that price. Let's go into a couple examples together. So we've hit a snag. We've landed on the ugly. What are we going to do? We're not going to panic. We're simply going to renegotiate. It's important to understand that your mortgage lender is going to use the lower of the appraised value or the purchase price as the determining factor of your loan terms. So what this really means is you can't move forward on the same loan terms as before. Let's look at why. If your purchase price was $500,000 and your desired down payment was 5%, that means that you had a loan-to-value ratio of 95%. Assuming this is the lowest down payment that you qualify for, this is really going to impact your mortgage terms. If the appraised value comes in at $485,000, what that's really going to do is increase the amount of cash or down payment that you have to come to the table with. Here's why. The maximum loan proceeds is reduced from $475,000 to $460,750. This represents your maximum loan that you can take out from the bank. So now your cash to close or your down payment went from $25,000 to $39,250, an increase of nearly $15,000. So again, this is not going to be a valid option for most buyers. Just come up with an additional $15,000. So let's look at what we do next. We simply renegotiate with the seller. Before we move on to renegotiating with the seller, let's talk about the appraisal dispute process. This typically happens leading up to the renegotiations. This is when the realtors come together to dispute the appraised value with the appraiser. Typically, this won't end well for the buyer or the seller because the appraiser is usually a highly trained, highly educated individual. So arguing with them on an opinion-based value typically doesn't go in our favor. So assuming that the appraisal dispute didn't go in our favor, our only option now is to renegotiate with the seller. This is where our appraisal contingency really gets to shine. We would approach the seller and notify them that if they do not come down in price, we are going to walk away from the transaction. The seller knows that it's not good that the value of the home came in low. Most likely, they're going to have a very similar issue if they relist and there's another lender on the other side of the transaction. So their options are limited. Do they want to look for a cash offer without the need for an appraisal? Or do they want to simply come to terms with a buyer who's willing and able and already at the table? Most of the time, the seller is going to simply elect to renegotiate and come down in price. It's always best to have the minimum specified purchase price match the purchase price in your appraisal contingency. Let's look at this example. If the minimum specified price would have been $485 on this deal, you would have been out of luck and had to move forward with the deal, which means you would have had to come up with an additional $14,250 of a down payment, or you risk losing your earnest money deposit, both which are pretty terrible options. This just highlights the importance of your appraisal contingency. Not all properties make value, no matter what the listing agent wants you to believe. So it's important to protect yourself. Most transactions go smoothly, without a hiccup or a snag during the appraisal process. However, you're a successful homebuyer, which means you need to always be prepared for the worst possible outcome. This will guarantee that you're not putting unnecessary money at risk and that you're actually reducing the risk as you go. I'll tell you, in 2020 and 2021, when the market was on fire, we saw a lot of buyers put unnecessary money at risk by waiving appraisal contingencies at all costs. They wanted to be competitive, they wanted to compete with cash, and they desperately wanted to secure their dream home. But they didn't look at the other side of the coin. They didn't think it would happen to them. And when the appraisal missed, they were out their earnest money deposit and they weren't in a position to buy a home for another year or two. So don't let this be you. Make sure that your appraisal contingency is strong, and if for whatever reason you're considering waiving it, make sure you understand the downside risk associated with it. So we're happy with the price of our home, and now we understand the home's value after going through the appraisal process. Let's make sure that the home is properly covered and that you have proper insurance on one of your biggest assets. Let's talk about homeowners insurance. Homeowners insurance is simply coverage on the home that will protect you from major losses or damages. The cost of homeowners insurance will typically be one of the largest line items for buyers when they're buying property. So it's important to understand that this varies from region to region and from area to area. So for example, if we use Texas as a good example, if you look at a city like Austin, which is well insulated in the middle of the state, and you compare it to Houston, which is a coastal city, the cost of insurance in Houston is going to be anywhere from 2 to 5 times the cost compared to the same insurance coverage in Austin, Texas. Most of the time, your lender is going to help you out and give you a ballpark estimate of what this insurance is going to cost. However, it's on you as the buyer to go out and find a local insurance agent or broker to work with. Our advice is quite simple. Work with a local insurance broker instead of a captive agent. A broker is going to represent you as the client. They're going to be able to shop all the major carriers across the state or across the country to bring you the lowest price possible. As mentioned in the last class, some states now have HOI or homeowners insurance contingencies in the contract, but this is still pretty rare. So if you don't find yourself in one of these states, just make sure that you take the brunt of the responsibility and get these quotes up front and do a thorough review comparing a couple different insurance agents. Usually you want to get the first quote during your option period, and you want to bind this prior to closing.